Good day, everybody. My name is Ted Gardner. I'm one of the portfolio managers on Westwood Salient's energy infrastructure team. Today, we are going to touch on a few performance highlights as well as some of the developments that we've seen arise already from the Iran war. Looking first at performance, it was another positive month for energy infrastructure with the AMNA up 2.6% and the AMEI up 2.3%. MLPs outperformed a bit during the month of April with the AMZ up 4.4%. Year to date, that brings the returns for the AMNA and AMEI to just over 26%, while the AMZ is a bit behind at 22%. Broader energy, looking at the XLE and XOP, were actually down slightly for the month of April, while the oilfield services, or OSX, was up 8.4%. Year to date, still some very strong returns from all three of those, with the XLE up over 34%, XOP up 41.7%, and the OSX up over 45%. Oil had another positive month with a 3.6% gain, and that brings its year-to-date gain to 83% due to the Iranian war. We've also seen the 12-month strip rally 7.9% in April and almost 49% for the full year. Looking at individual returns, Solaris Energy Infrastructure was the highest gainer for the month of April with a 30.7% return. The company announced a new behind-the-meter project with a brand new customer, so the market did like that news and rallied the stock quite a bit. On the downside, Venture Global had the largest loss at 15.8%. We think that was just a function of the back and forth headlines about perhaps the war ending. However, when we look at the year-to-date period, Venture Global is still the highest gainer at 94.9%. Again, the primary reason for that is that they are exposed to global LNG spreads, which have widened quite a bit due to the impacts of the Iranian war. We actually don't have any negative returns for the year, although we do have a few that we'd call laggards that are only up in the mid-single digits for the year. Turning now to some of the opportunities arising from the war. As of this recording, we are 72 days into the war, and we have an average undersupply of just over 8 million barrels per day, which brings us to a total inventory draw of just under 600 million barrels. In addition to rebuilding these inventories, we also believe that countries with an SPR will want that SPR to be full in the future to avoid this type of disruption ever again. If we look just at the US and Chinese SPRs, which are two of the largest in the world, they were a combined 539 million barrels below capacity coming into the year. So when you add it up, we already have an additional layer of demand of over 1.1 billion barrels. We believe this inventory restocking cycle will lead to a higher floor on oil prices, which will then incentivize U.S. producers to increase production, ultimately resulting in higher volumes and cash flow for the energy infrastructure companies in which we invest. And we're already seeing some green shoots on that front. The Dallas Energy Fed conducts an energy survey twice a year, and the most recent results came out in late April. They asked producers this time around if they had any change in drilling expectations since the beginning of the year. And historically speaking, we tend to see the smaller and or the private producers move more quickly than larger companies when it comes to activity levels. And we can actually see that play out in the survey results, as 29% of the smaller E&Ps expect to slightly increase drilling, and another 29% expect to significantly increase drilling. Meanwhile, 69% of the large E&Ps expect no change, although 23% did say they expect a slight increase and 8% expect a significant increase. And for some real-world examples from first quarter earnings, Diamondback, which is a larger company, said that they will add a frac crew to complete some of their drilled but uncompleted wells, also known as DUCs, and that they will also add 2 to 3 rigs in the second half of the year. ConocoPhillips also said that they will add 1 rig in the Permian, and then California Resources, which is a smaller company, said they expect to move from 4 rigs to 7 rigs in the second half of the year. So we're definitely seeing those signs of production growth on the horizon. In terms of what that means for midstream, we think that the CEO of Enbridge summarized it very well on their conference call, where he said that the current environment has the best growth opportunities that he has seen since the 2012 to 2016 period. And if you recall, that was a high growth period and these companies traded at much higher multiples than we see today. We agree with his assessment and believe that we are entering an accelerated growth period over the next 5+ years. Thank you for your time today. Please reach out to your Westwood representative with any questions.